Well, the RBA meeting next week in play, with the market pricing in a 97% chance of a rate cut. We have, though, in the last 24 hours seen ANZ come out and say they have a little less conviction on the cut now, albeit still suggesting 2/3 of a chance of a 25 basis point cut. Yet NAB remains a standout. It's calling for a supersized 50 basis point cut still. Well, for more on what's expected, I spoke with Gareth Aird, Head of Australian Economics at CBA, for his take.
Go back to October last year, we thought the RBA would be cutting rates 4 times through this year. Obviously delivered the February rate cut. We're expecting them to cut the cash rate by 25 basis points next week on Tuesday. The inflation data was pretty good for Q1. It was very much in line with the RBA's forecasts, as was wages growth. The spending side of the economy has been relatively soft through the first quarter of this year, but the unemployment rate is still pretty low at 4.1%. But the reality is that monetary policy is currently at a restrictive setting. The RBA is on record as saying that. And if the inflation data is giving you the green light to normalise the cash rate, which we think it is, then the right policy response next week will be to cut interest rates by 25 basis points.
Well, I want to sort of dive into that, because you've said in your note today that the inflation dragon's been slayed.
Yeah.
Which is a big call, because, I mean, you look at the wages numbers this week. I know they were relatively in line, but a little bit hotter than expected, and that certainly made the headlines. And then, you know, you have jobs numbers, which looked at face value pretty strong, even though they can be volatile. So does that not at least put you on alert for inflation going forward?
I guess we're on alert, but we look at the data, and if you look at the last 6 months of inflation data, in terms of the quarterly numbers, you had a 0.5% increase on the trim mean and a 0.7%. So if you take a 6-month annualised rate, which is basically annualising those two numbers, you're at 2.5%, which is smack bang in the middle of the RBA's target band. The wages data on Wednesday was a little bit firmer than we expected, but it was in line with what the RBA had forecast. And if you look at the detail there, and the strength in the wages number was really coming through some administered growth in terms of childcare and public sector. But if you look at the private side, those negotiating wages on an individual basis, you've seen quite a softening there. So we think the wages story is not a problem for the outlook for inflation. Inflation data has been looking pretty good. We also think as we move through this year, because of what's going on with US trade policy, that Australia is actually going to be the beneficiary of importing less inflation through the China channel. In other words, if China's not selling the US as much, they're going to be selling it to the rest of the world at a slightly cheaper price, and we'll benefit there. And that's going to feed in positively to our inflation data. So we did say the inflation data, the inflation dragon has been slayed, or other people talk about the genie going back in the bottle. Economists have these strange sort of turns of phrase, but yeah, we're pretty comfortable now with the inflation outlook, and we think the RBA will broadly lean into that and normalise the cash rate. Would
you go as far to say that the risk for inflation is to the downside?
Well, it depends as to downside as in like below target. No.
Or at least just coming off from here.
Yeah, look, the annual rate will continue to come down on an annual basis, and the 6-month annualised rate, as I said, is 2.5%, but the annual rate of underlying inflation is 2.9%. Now, that's a function of the 4 quarterly numbers that are sitting in the annual calculation. But if you look at what's going to be dropping out next quarter, it's actually a 0.9% on the trim mean. So if you replace a 0.9% with a 0.7 or a 0.6, then your annual rate is going to come down. So we think broadly, as we think about the picture this year, inflation's actually going to settle around the midpoint of the RBA's target band on an underlying basis. We've got wages that's sort of tracking in the low 3s. It's pretty much consistent with the inflation target. So for us, the picture all looks pretty good at the moment.
In terms of going forward then for rate cuts, are you sticking with your call? Are you on track for a terminal cash rate? I think, where was your terminal cash rate?
We've got it at 3.35%, which means another 75 basis points of cuts from where we are today. And obviously we think we're getting a 25 basis point cut next week. It'll be interesting to hear what the RBA actually says on Tuesday and also what they produce in terms of the economic forecast.
Do you think they'll be careful on what they produce, given it's, I mean, you said it in your note yourself, but it's a real signalling event, isn't it? I mean, if they go too hard on forecasts, that's a signal for what's to come.
Well, they'll put out their economic forecast, but I think they'll stress that there's a lot of risk around the forecast at the moment, given how much uncertainty there is in terms of the global economic backdrop. And you know, US trade policy has been changing almost on a daily basis. Our sense, though, is that the RBA, they'll remove some more restrictiveness on Tuesday. They will still tell us, though, that policy is still restrictive because they think the neutral interest rate is somewhere between 3 and 3.5%. So if we end up on Tuesday with a 25 basis point rate cut, That takes the cash rate to 3.85%. So we're still restrictive. So the case then as we move through this year to continue to cut rates is there. But our base case here is that provided the labour market data still looks pretty robust, which it has been, the RBA won't feel like they need to rush to get to this kind of neutral number. They'll just be very much data dependent. I think, though, in terms of what they tell us on Tuesday, they won't give us any forward guidance. Okay. In other words, they'll cut the cash rate, but they won't tell us what they think they're going to be doing after that. And it will just be about the data making the case as to when the next time is the right time to cut rates. And we've got it at the moment penciled in for August, assuming they cut rates next week, the next one being August.
In terms of household consumption, really weak in Q1, retail sales as well, it was basically 0% volume growth.
Yeah.
What will boost, I mean, will rate cuts do anything to that? Will rate cuts actually boost that part?
Oh, absolutely. But I think it's worth keeping in mind that rate cuts and rate hikes work with a lag. We talk about the lags of monetary policy, and everyone on the way up was talking about the lags. The lags also work on the way down. So the February rate cut that we got was not going to shift the needle for Q1 household consumption. But as we move through this year and rates start to come down, I think you'll see two things. Basically, those people that have been struggling under the weight of higher mortgages, the rate relief comes, they can adjust their mortgage repayments down if they like. That gives them a little bit of extra money to spend. Also, with inflation moderating, that helps to boost real incomes. And the other thing too is home prices are likely to be moving up as rates come down, so that makes people feel a little bit better. They're more likely to go out and spend, or certainly those that own a home. And all of that starts to generate a pickup in private demand growth in the economy. Businesses see a pickup in sales, that helps hiring, and the whole thing basically generates a pickup in GDP growth. So we're expecting GDP growth to be around 2% this year, and last year it was about 1.25%. So ultimately, the rate hikes will work to stimulate private demand grove.
Just finally, we mentioned it before about Trump's tariff policies and the trade wars we've seen. Very hard to predict, as we know, and even Jerome Powell said, it will be reactive and not preemptive, which is probably the right move.
Yep.
Will the RBA be the same? How much does it impact the RBA going forward? I mean, you've said some net positive impacts even, but do they just watch and wait? Will they comment? Will they have any commentary around it? Do you think? How do they play such an unpredictable future?
It's a good question. I think they're going to talk about uncertainty. I think that word's going to appear a lot next week, and rightly so, because US trade policy has been moving so much in a short amount of time. And in a lot of ways, I think the RBA is actually in a good position to be meeting next week, as opposed to if they were meeting 2 or 3 weeks ago, because we've got a lot more clarity on where things are at. And we did get some good news this week in terms of a de-escalation of the US-China trade risk. I suspect the RBA will think, for Australia, we're pretty well positioned through this. Our direct exposure to the US is pretty minimal. Commodity prices are still pretty buoyant. So I don't think there's any real need to sound too concerned, other than flagging that there's a lot of uncertainty and we're just going to have to play it by ear. Very different in the US, obviously, because the Fed is commenting on policy which is affecting the US directly, whereas in Australia, you've really got to take a view of how does this global story, particularly through the lens of China, impact us here in Australia. And our base case is that for the foreseeable future, Australia is pretty well positioned, and we think the RBA will probably share that view on Tuesday.
All right, will be an interesting start to the week next week. Gareth, really appreciate your time on the program. Thanks for joining us.
Thank you.